On a map, the Strait of Hormuz looks almost too small to matter. At its narrowest, the waterway is roughly 33 kilometers across. Yet every day, a procession of tankers carries the energy of entire economies through this one exit from the Persian Gulf. The strait does not have to close for the world to notice it. A change in perceived risk can alter insurance, freight, delivery schedules, and the price traders are willing to pay. In June 2025, maritime traffic was not blocked, but Brent crude still moved from $69 a barrel to $74 in a single day amid regional tension. That example shows correlation and rapid repricing, not a single proven cause. So the real question is not whether one country can simply switch the world economy off. It is why so much economic activity has been compressed into a route with so little short-term redundancy. To answer that, we have to look beyond the dramatic map and follow the flow. The Strait of Hormuz lies between Iran to the north and Oman to the south. It connects the Persian Gulf with the Gulf of Oman and, beyond it, the Arabian Sea. For the Gulf seaborne exports, this is the only way out. But the famous 33-kilometer figure can be misleading. It describes the strait at its narrowest, not an open highway on which ships can sail anywhere they choose. Deep draft tankers follow organized traffic lanes, keep separation from opposing traffic, and navigate around islands, shoals, and coastal waters. Geography becomes infrastructure when millions of barrels must pass through the same managed corridor every day. The cargoes originate at terminals in Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, Iran, and Qatar. They leave the Gulf, turn into the Arabian Sea, and then split toward Asia, Europe, or more distant markets. A line on a map becomes a timetable of ships, pilots, terminals, contracts, and refinery deliveries. In the first half of 2025, the Strait of Hormuz carried an estimated 20.9 million barrels per day of crude oil, condensate, and petroleum products. That was roughly one-fifth of global petroleum liquids consumption and about one-quarter of all oil traded by sea. Those two percentages use different denominators, but together they reveal the scale of the bottleneck. This is not a claim that one-fifth of every country's fuel arrives directly through Hormuz. Oil is traded through a global system. A disruption in one region changes which cargo is available elsewhere, how far ships must travel, and what refiners must bid for replacement barrels. The importance of the strait therefore comes from marginal supply. Markets price the next available cargo, not the average barrel already sitting in a tank. When a large flow becomes uncertain, a relatively small gap can move prices across a much larger market. Volume, concentration, and limited alternatives turn local geography into global leverage. The center of gravity is increasingly Asian. In the first half of 2025, AIA estimated that 89% of the crude oil and condensate moving through Hormuz went to Asian markets. China, India, Japan, and South Korea together accounted for 74% of all Hormuz crude and condensate flows. That does not mean every country faces the same exposure. Import contracts, refinery designs, inventories, domestic production, and alternative suppliers all differ. But it does mean that a shock at Hormuz would reach Asian buyers first and then reshape cargo prices everywhere else. And oil is only half the story. During the same period, about 11.4 billion cubic feet per day of liquefied natural gas passed through the strait, more than one-fifth of global LNG trade, primarily from Qatar. Gas markets are connected by ships, but they are not perfectly interchangeable. Terminals have limited capacity, voyages take time, and replacement cargoes may already be promised to another buyer. Hormuz is therefore both an oil bottleneck and a major hinge in the global gas system. Imagine that passage becomes slower, more expensive, or temporarily uncertain. The first effect is operational. Ship owners reconsider routes and schedules. Insurers reassess war risk premiums. Traders add a larger risk discount to cargoes that may arrive late. The next effect is financial. Futures and spot prices adjust before a physical shortage is fully visible. Refiners then face a choice: pay more, draw inventories, reduce runs, or search for a substitute grade that may not fit their equipment as efficiently. It notes that even a temporary blockage at a major choke point can create supply delays and higher shipping costs, potentially raising world energy prices. From the refinery, the pressure can spread to diesel, jet fuel, petrochemical feedstocks, and marine fuel. Transport and production costs can then reach airlines, freight companies, manufacturers, and some food supply chains. But there is no honest one-number forecast for this chain. The result depends on how much traffic is affected, for how long, at what time of year, and with how much inventory and spare production available. A brief scare and a prolonged physical interruption are not the same event. The strait is an amplifier, not a magic button with a fixed price attached. Why not move the oil around the strait by pipeline? Some of it can be. Saudi Arabia's east-west system can carry crude from the Gulf side of the kingdom to Yanbu on the Red Sea. The United Arab Emirates has a pipeline from its onshore fields to Fujairah, outside the strait. Iran has also built the Ghor-e-Jask route toward the Gulf of Oman. Together, the Saudi and Emirati systems could provide about 4.7 million barrels per day of capacity that bypasses Hormuz, according to AIA's 2026 choke point assessment. Iran's route had an effective capacity of roughly 300,000 barrels per day, with limited recent loadings. These are meaningful buffers, but compare them with 20.9 million barrels per day moving through the strait in the first half of 2025. Capacity is also not the same as immediately available spare capacity. Pipelines may already be in use, crude must be connected to the right network, and receiving ports need tanks and loading slots. A detour can protect part of the flow. It cannot reproduce the flexibility and scale of the sea lane overnight. The world is not defenseless. Companies hold commercial inventories. Governments maintain strategic stocks. Some producers keep spare capacity, and refiners can sometimes adjust their crude mix. Pipelines can redirect part of the supply, while higher prices encourage conservation and attract cargoes from farther away. These buffers matter because they buy time. But they solve different problems. An inventory is a stock; it can replace missing barrels for a limited period. A pipeline is a flow; it can move a certain volume each day, but only between connected places. Spare production must still reach a port in a suitable refinery. Demand reduction takes time and can impose economic costs of its own. The system's resilience is therefore layered, not absolute. In a short disruption, inventories and rerouting may calm the market. In a longer one, the same response gradually becomes more expensive, and the location of each barrel matters more. Resilience is not the absence of vulnerability. It is the ability to keep essential flows moving while the system adapts. This is why navies, coastal states, importers, exporters, and shipping companies all watch the strait. Their interests overlap, but they are not identical. Exporters need reliable access to customers. Importers need predictable deliveries. Shipowners need safe navigation and insurable voyages. Coastal states have security and sovereignty concerns, while outside powers worry about the wider trading system. International law provides a framework rather than a remote control. Article 44 of the United Nations Convention on the Law of the Sea says that states bordering straits shall not hamper transit passage and should publicize dangers to navigation that they know about. States can disagree about legal interpretation and enforcement, and law does not erase political risk. Military presence can deter some threats and create new calculations, yet it does not make one actor the owner of the route. The phrase "whoever controls Hormuz controls the world" is memorable, but analytically weak. In practice, passage emerges from law, geography, deterrence, commercial judgment, and the restraint of many actors at once. Seen from space, the tanker tracks through Hormuz are thin lines of light. Seen from inside the economy, they are moving pipelines that connect wells, ports, refineries, power systems, aircraft, trucks, factories, and homes. The world's vulnerability is not that energy exists in only one place. Oil and gas are produced across many regions, and buyers can change suppliers over time. The vulnerability is speed. New pipelines, export terminals, tankers, storage caverns, and refinery configurations take years and large amounts of capital to build. A market shock asks for an answer in days. That mismatch gives the Strait its power. The lesson is not that closure is inevitable or that panic is rational. It is that efficiency without redundancy creates hidden concentration. The strongest energy system is not the one that never faces disruption. It is the one with enough routes, stocks, information, and cooperation to adapt before a narrow passage becomes a global shortage. Resources create wealth. Connections make that wealth usable. And in a networked world, the most strategic asset may be the alternative path that is ready before anyone needs it.